My name is Seth Freuberg. I'm the Director of Options Training here, and I run the Options Trading Desk at SMB U in Manhattan. I'm here with a group of traders on SMB's Equity Trading Desk, and today we're going to be talking about options trading. Many of you watching this right now may be options traders yourselves, or you may have dabbled in options trading, and this is for you to help you to learn and improve your game as an options trader. So I'd like to start out our presentation today by just mentioning that this webinar, this session today is being given for educational purposes only. SMB Training is not a broker-dealer, and today's session involves no relevant positions. It's important to understand that the data and pricing you'll see on the demonstration today are computer simulated figures, and therefore, because of slippage, liquidity, and commissions, you may get different prices in the marketplace if you attempt to place the same trades that we're discussing today. Having said that, what I'd like to talk about today is the most common mistake that is made by an options trader, and that is, I bought a call, my stock went up, and I still lost money. Those of you who are equity traders and dabble in options will have had this experience. Most definitely, you have an experience where you go ahead and you buy a stock, and of course buying an option gives you 100 shares of that same stock, basically control of 100 shares of the same stock. You assume if there's upward movement in the stock and you buy a call, you're going to make money. But guess what? Sometimes it doesn't work out that way, does it? So we're going to try to explore why that is the case today and a way to solve that problem. So no, it's not always going to work out if the stock goes up and you buy a call. So let's go over some quick basics just to make sure that everyone understands the basics of options. When you sell an option, you have an obligation, and when you buy an option, you have a right. So let me give you an example. When you buy one American-style IBM January 2011 150 call, let's say this was back a couple years ago, you've got the right to buy 100 shares of IBM at a price of $150 per share anytime between the day you buy it and January, the third Friday in January in 2011. That's when monthly options expire. If you're the seller of that call, you've got that same obligation. You've got to deliver IBM shares to an owner of a call at $150 per share if that owner asks for it during the life of that call. So even if IBM goes up to 180, you've got to sell it to them for 150. So that is what selling an option is. So just as a quick review on equity options meaning options on stocks. If you're long an equity call option, you've got the right to buy 100 shares of a stock. These are 100 share increments at the strike price on or before expiration. If you are short an equity call, in other words, you sell an equity call, you have an obligation to sell 100 shares of the stock at that strike price on or before expiration if the owner so desires. If you're long an equity put, if you buy one, it means you have the right to put those shares or sell those shares to someone at the strike price of your put. If you're short that equity option, in other words, if you're the writer of that option, you have an obligation to buy those shares at that strike price as well. So those are just the basics of what a put is and what a call is. Now, let's give you a vivid example of why you can be long a call, which means you have a right to buy a stock at a certain price. You can be long that call. The stock goes up, just like you're expecting. So you would think that that right gets more and more valuable for you, but in fact it doesn't. How can that be? And let's give you a good example, and then we'll show you how to solve this problem. So let's say it was May of 2013, and at that time Apple was trading at $4.35. So suppose we bought a call of Apple at $4.35, the $4.35 call for May, 18 days later, the May expiration. This is a snapshot of the pricing on April 30th. So if you bought that $4.35 call for $990, you are essentially controlling 100 shares of Apple. So if Apple on expiration day went up to $4.55 and closed at $4.55, you could go in and buy those shares for $4.35 and sell them 1 second later for $4.55, the market price. So you'd make $20 per option, per share. Therefore, that option would be worth $20 times 100 actually, because it relates to 100 options shares. So you would think, hey, if Apple goes up above today's price by expiration, I'm going to make money, right? Let's see what happens. One question you would have to ask yourself is, if I'm really bullish on Apple, why would I buy 100 shares of Apple and have to spend $43,500? This is a stock selling for $435 when I could pay $990, a tiny fraction of that, and control 100 shares. If I'm bullish, all I'm risking is $990, and if the thing really takes off, that could be worth $20,000, right? Wouldn't my return be much better if Apple rallied with the lower capital outlay of the call instead of the stock? Doesn't that sound like a logical question? Let's see what happens. On expiration day, Apple actually rallied 4.5 points, and look what happened to the option price that day. It was down from the $990 I bought it for to $560. The option had actually dropped in value. And you can see why. There's 1 day left. This option has one trading day left in it, and the stock is now at $439.88. So why would someone pay much more than $5 for it? Who knows if the stock could go down that day from this point? So even though I paid $9.90 for it and the stock went up, the option went down. This happens all the time. So how did that happen? Options are not like stocks. They're different. They have different elements to them that affect their pricing. One of them is called time decay. And if you learn more about options, you'll understand what that is. Another is called volatility. And again, it's a factor that you get a better and better feel for as you trade options and you learn about options. Those two factors affected this option so greatly that even though the price of the stock went up, the call went down. That 435 call was a victim of both of these factors. So how can we solve that? What's a better mousetrap for using options to play our directional view of Apple, which is that Apple's going to go up? And the answer is, what if on that same day, instead of buying the Apple call, we sold the 435 Apple put and bought the 430 May put for protection, so that if Apple really dropped, the worst it could get for us is 430. This is called a put vertical credit spread. So here's what we would do in this case. You see on the screen now the 434 put. We're short 4 of those. Remember, we were long 1 call option at 435. In this way of handling things, we're going to use exactly the same amount of capital. And if you learn more about options, you'll understand why that $986, very, very close to the $990, is the amount of capital that you'd be using up for this trade. And the cash flow you'd receive would be $1,000. You're selling the 435 option for $1165. You're buying it for $910. You're buying the 430 for $910. That gives you a net of $1,000 of cash that comes into your account when you enter into this obligation. This time now, instead of time working against us, as it did in the example of the call, time is working for us. So basically, any price above 430, and the option will, and then all of our options will expire worthless. If we've entered into this option spread and Apple goes to 436 on expiration day, what will the put options be worth? Anyone in the room have an idea? They would be worthless. That's correct, because who would want to sell me Apple shares at 435 when the stock is trading for 436? No one will do that. So the 435 is worthless, and the 430 is worthless. So I got $1,000 in my account, and the one who was on the other side of that transaction has no value. So I win. I get the $1,000. So let's take a look at that exact same point in time on expiration day. On expiration day, at 9:30 in the morning, the same analysis we did of the previous example, we have a gain of $776 because Apple has appreciated up to $439.88, and the market is losing faith that within the next 6.5 trading hours, Apple will drop below $435, and that $435 put will have any value at all. And so therefore, instead of us losing $400 some on the call, we made $700 with the same capital outlay by selling a put credit spread instead of buying a call. We put time on our side instead of time being our enemy in the case of the long call. So that is a way that you can use options more reliably than you can by simply going out and buying the calls. Just to look back at this, take a look at this graph. From any point above 435, you will make the maximum credit you received on the stock on this day, and on this option spread on this day, which would be $1,000. If the market closed at 435 and 1 cent on expiration day, you will receive the full $1,000 that you entered into, as opposed to losing $400 for buying a call that you would have thought would have been very reliable. In fact, it lost value when Apple appreciated. So what's the moral of the story? Don't buy the long call, sell the put credit spread. So if the stock goes up, goes nowhere, or slightly down, you're still likely to earn a profit on your options trade. And I want to emphasize that part about slightly down. If you look at this graph now, anything above 435 we just established will expire worthless, right? Well, because you received $1,000, the market could actually drop to as low as 432, and you'd still eke a small profit out of this trade. So think about what I just said. If you were bullish on Apple and Apple appreciated 1 cent above 435, you get $1,000. If it closes at 40.35, you get $1,000. If it drops 2 points, you still make some profit. That's because you have put time on your side with options as opposed to time working against you. So you now have 3 scenarios. When you're bullish on a stock, if it's bullish, you obviously win. If it's neutral, you obviously win. If it goes down slightly, you win also. So it's a very, very good situation as far as giving you leeway for your directional opinion to be not as right as you thought it would be. So, of course, you will lose on this trade if the Apple stock goes down dramatically. You're going to lose. But the most that you will risk is the $986 that you had in the trade in the first place, which is what you had in the call. So therefore, your risk is kind of mild in this case, and you get a very, very fine return if you're even a little right about Apple. So that is a put credit spread. Now, in our next video, we're going to discuss what if you do not have a market opinion? Or putting it another way, what if you think the market is just going to channel for a while? Or if you just don't think you're very good at technical analysis and you really don't know how to form such an opinion? Well, we have an options trade that will solve that problem. We have a way you can make money if the market doesn't move at all. The room here is full of day traders. If the market doesn't move, you can't make money. With options trading, that's actually a great environment to make money when the market is not moving. And in our next video in this series, we'll teach you how to do that. So we'll see you in our next video.